In the early 2010s, millions of people were mailing in their spit to a startup called 23andMe. In return, they got something powerful: a window into their ancestry, their health, even their potential risk for serious diseases. It was science fiction made personal. But in 2025, 23andMe, once a Silicon Valley darling, valued at nearly $6 billion, filed for bankruptcy. This is the story of how one of the most recognizable names in consumer genetics went from the front lines of innovation to a company struggling to maintain trust and solvency. 23andMe was founded in 2006 by Anne Wojcicki, Linda Avey, and Paul Kusenza. Wojcicki, a biotech analyst by training, and then the wife of Google co-founder Sergey Brin, helped steer the company's vision: democratizing access to genetic information. The idea was bold. For $999, customers could send in a saliva sample and receive insights into hundreds of traits, health risks, and ancestral background. The service launched in 2007 and caught early attention. By 2008, Time magazine named it the invention of the year. Over the years, the price dropped sharply, from nearly $1,000 to just $99 by 2012. That shift opened the floodgates. With the help of publicity from figures like Oprah Winfrey and early backing from Google, the company rapidly scaled. For millions, it became a novel way to connect with their roots. And for some, a way to discover health information that had previously been locked behind clinical gatekeeping. But that kind of access also raised questions. In 2013, the U.S. Food and Drug Administration stepped in. The agency ordered 23andMe to stop selling its health-related genetic tests, stating the company had not provided sufficient evidence that the results were accurate or clinically valid. For almost 2 years, 23andMe shifted to offering ancestry-only reports in the US, while working with the FDA to get back into the health space. In 2015, they received authorization to resume offering limited health reports. Over time, that list expanded. Behind the scenes, though, the company was also growing another asset: a massive trove of genetic data. By the late 2010s, it became increasingly clear that 23andMe's long-term strategy wasn't just about selling tests. While most customers saw a one-time product, the company was building one of the largest databases of genetic information in the world. In 2018, pharmaceutical giant GlaxoSmithKline invested $300 million in a partnership to use 23andMe's anonymized genetic data for drug development. According to public disclosures, this was just one of over 30 research collaborations with companies in the healthcare space. The company emphasized that data was shared only with user consent and anonymized, and that personal identities weren't included in research sets. Even so, the deal prompted broader conversations about privacy, consent, and what customers truly understood about how their data was being used. By 2020, 23andMe had over 12 million customers. It had weathered regulatory challenges, launched partnerships, and positioned itself as a future player in personalized medicine. In 2021, 23andMe went public through a SPAC merger with VG Acquisition Corp., a blank check company backed by Richard Branson. The deal valued the company at $3.5 billion and brought in hundreds of millions in cash. It was a high point, but also marked the start of deeper challenges. Consumer interest in genetic testing had begun to cool. Media coverage pointed out a key limitation. Customers typically bought a DNA kit once. There was no obvious way to generate recurring revenue. Unlike a subscription-based model, the business had to constantly find new customers to maintain momentum. To diversify, 23andMe acquired Lemonade Health, a telehealth provider, and expanded into clinical services. Still, the company continued to operate at a loss. By 2024, its stock was trading under $1. analysts noted that user growth had plateaued and that the core product had hit market saturation. Then came a major setback. In 2023, 23andMe disclosed that a large volume of user data had been accessed without authorization. Hackers used credential stuffing, exploiting reused passwords from other breaches, to log into user accounts and scrape information from the DNA relatives feature. Roughly 6.9 million user profiles were affected. The exposed data included ancestral backgrounds and genetic traits, raising serious privacy concerns. The company faced over 30 lawsuits and later agreed to a $30 million settlement. Regulators and privacy advocates began scrutinizing its data practices more closely. While 23andMe maintained that its core systems weren't directly breached and that users had not enabled two-factor authentication, the event significantly impacted public trust. By early 2024, financial pressures intensified. Anne Wojcicki made an offer to take the company private at 40 cents per share. The board rejected the bid as insufficient. Shortly after, most of the independent board members resigned. In March 2025, 23andMe filed for Chapter 11 bankruptcy protection. At the time of the filing, the company listed liabilities in the range of $100 million to $500 million. Wojcicki stepped down as CEO, and longtime CFO Joe Selsavage took over in the interim. To stay afloat during bankruptcy, the company secured up to $35 million in financing and announced plans to sell off most of its assets. The biggest of those assets? Its vast genetic database, containing data from more than 15 million individuals. That raised new questions. California's Attorney General issued a consumer alert reminding users of their rights to request deletion of personal data. The FTC also issued guidance stating that any buyer must uphold 23andMe's original privacy promises. The company reiterated its commitment to honoring user privacy and said that no personally identifiable information would be sold. Still, the moment served as a wake-up call about how sensitive personal data, especially genetic data, is handled in the commercial space. 23andMe helped pioneer consumer access to genetic testing. It gave millions of people insights into their ancestry and health that were once reserved for specialists. But it also walked a fine line between innovation and privacy, and between hype and business reality. The company's bankruptcy doesn't erase its contributions to biotech or the way it reshaped public awareness of DNA, but it does offer a cautionary tale.